Welcome to Safe Option Strategies' presentation of Adjusting the Bull Call Spread. This class is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this for any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk, and you are solely responsible for any losses you may incur as a result of trading. All right, so anytime we do an adjustment class, the first thing I like to do is just review the strategy that we're talking about. So a real quick review of the bull call spread is a debit spread, which means we're going to buy to open the trade overall, we're going to sell to close the trade overall. It takes advantage of those stronger bullish trends. A slow-moving bullish trend, not the best thing in the world for a bull call spread. And then that can be really hard to predict. I'll be honest with you. I don't place a lot of bull call spreads because it's hard to predict when you're going to get that really fast movement and that strong bullish movement versus just that slower, steady bullish movement or a flattening. To create the trade, to structure the trade, the long call is placed at or just out of the money, and usually 45 to 90 days to expiration. I'm going to talk a lot in this class about why we want that 45 to 90 days to expiration. The long call is our primary money-making option. That's where we expect our profits to come from. The short call is placed one or two strike prices higher, always in the same month or week of expiration. More often than not, we're going to use monthly options, the ones that expire on the third Friday of the calendar month. But there might be a scenario that we're in a weekly option. It doesn't matter. The same expiration date is where the short call needs to be, and it needs to be at a higher strike price. This is our secondary or our hedging option. The cost basis, also referred to as the net debit of the trade, is whatever price we pay for the long call minus the credit we take in on the short call, and that of course is equal to our maximum risk. Our maximum reward, the most money we could make, is going to be the difference between our strike prices minus what we paid to be in the trade. If we had a $25 and a $30 strike price, just a quick review here. If we had a 25 strike long call and a 30 strike short call, we have a $5 difference between our strike prices. If the cost of being in this trade, the money we took, the money we paid to get into this option, the money we took in to get in this option, if the combined cost of that were $2.15, we subtract this $2.15 from the difference in the spreads, and that means the most money we could make in this trade would be $2.85. So our maximum reward is going to be the difference between our strike prices minus our cost basis. Now, oftentimes that maximum reward is going to be upwards of 100% that we could possibly make, but a good target can be anywhere from 15 to 30%. Most of the time it's going to be a 20 to 25% return that we're going to target when we do a bull call spread. A good target time in the trade is less than 6 weeks. 2 to 3 weeks is preferable. We try a bull call spread. You're trying to catch that shooting star. You're trying to grab something as it's starting the strong move in an upward direction, and oftentimes those really strong movements don't last for a long period of time. 2 to 3 weeks is an ideal time to be in the trade. If you're in it for 6 weeks or more, probably you have adjusted the trade. So let's talk about adjusting the trade. Now, this is an older stock chart. You'll see some newer option chains that match up with the previous class and the newer option chains we used in the previous class. This is an older stock chart because it just perfectly illustrated when we might have to adjust a trade. A lot of times we're looking at our 3 technical indicators as a means of getting into a bull call spread. Now remember, the day you're seeing this and this and this, obviously none of this has taken place yet. None of that has happened yet. And you might be looking at those technical crossovers on the day those are happening, and you might even wait for this day when you're saying, look, there's this level of resistance right there. Remember, we talked in the first class, or in the bull call spread class, we talked about making sure there's room between where you're currently at and where that next level of resistance is at. And so maybe you see the technical crossovers and you're waiting to get that breakthrough. and you get into the trade because it makes that breakthrough level of resistance, or it appears to have done so, and then all of a sudden you get this inexplicable turn, or you get a reversal in the direction the stock is going. So if you were to get into this trade, say with a 37.50 bull call spread, thinking it has a good chance to get up to that 37.50 before it stalls out, all of a sudden you've got both of your options out of the money, and they're both losing money. And whatever you paid to be in this trade, a 250 spread, maybe you paid $1.30 to be in this trade, all of a sudden you're at risk of losing that entire $1.30 because the stock suddenly reverses directions on when your expectation was the strong bullish move. So what I've done right here is I've purposely placed this stock chart, this blank stock chart, right at the point in time. I've tried to match this up, saying here's where we would have gotten into the trade. Right when we got those technical crossovers, we would have jumped into this trade, hypothetically. And maybe we would have jumped in with a 34.36 bull call spread. And our expectation is the stock moves up, and we close the trade when we hit our primary exit. It doesn't have to move all the way to 36, but we know, we looked at the deltas, we know we've got that 0.20 or greater difference between our deltas. We know that, and maybe in this case, a dollar move up could get us the 20% profit that we want. Okay, now there's two different adjustments we've got to talk about, or two different things that would happen that we've got to talk about that would cause us to adjust the trade. Number one is, what do we do if the stock is still moving up? It's just not moving up as fast as we expect it to. So here we've got this trade structured, and we don't have to see the stock go all the way above $36 a share, but we know based on how fast the long call will gain value and how fast the short call will gain value, we know that we've got to have a move that's up into this $35 range, well ahead of the expiration of these options. Maybe we get continued bullish movement, but within a few days to a week, we recognize that we haven't caught that shooting star. We've got a slow, steady bullish movement. So even though we're getting the direction we need on the stock, we're not getting that direction fast enough. And we're looking at the value of both of these options start to disappear. And we're saying to ourselves, well, this isn't working. I can see that by the time I get to expiration, I might not even be in the money on my long call. So one adjustment that we can make when we're in a stagnant trend is to simply roll our short call into a nearer term expiration, possibly down to a lower strike price or both. Okay, at the very least, at the very minimum, we're going to roll into a nearer term expiration. That's the minimum. We may also decide to come down a strike price. Doesn't have to be just one, it can be a combination. It doesn't have to be just rolling it in. But what we're essentially going to do is create, through our adjustment, some type of calendar spread. Now think about this. If a stock is moving flat, time decay is taking place on this option. Just like it's taking place on this option, time decay is taking place on this option. The option that's farther out of the money, this is where our short call started out. The option that is farther out of the money, it is probably going to be losing value at a little bit faster pace. And therefore, a little bit of stagnant move right here, and when we buy to close this option, we should be able to buy to close it for less than what we sold to open it. So we've got a $2 spread here. Let's say hypothetically we paid $1.10 for this option right here, and we took in a credit of 30 cents right here. When we make a determination now that we're going to roll this option in, we're going to move this short call from the October expiration to the August expiration in this example. We're going to move that thing in. We should be able to buy to close this for less than 30 cents per share. We took in 30 cents per share money in when we opened the trade. Now there's going to be some money out involved in closing this. The close of this one is going to be money out. and the opening of this one is going to be money in. Now, this is really important. Ideally, whatever we open this option for, it would be ideal if it was as much or more credit than what we spent to close this one. It doesn't matter if it's equal to what we originally opened it for. If the money we can get right here, the money in right here, equals the money out right here, our original starting cost basis, it would have been 80 cents per share in this case, the 110 minus the 30. Our original starting cost basis will remain the same. If what we bring in right here is more than what we spend right here to close, this cost basis could go down. And that alone helps our trade. Rolling a short call from one expiration into a nearer term expiration, but leaving it at the same strike price, is never going to result in equal to or more money in than what you spent on the money out. So to be able to accomplish that, you probably have to roll it not only in, meaning to a nearer term expiration, but you're probably also going to have to roll it down. Now, the instant where we might not do that is if our long call actually has moved in the money, but the trend still looks slow enough where our short call, it doesn't look like the stock is trending, or trajectory doesn't look enough to get profitable on the trade, and maybe a roll into a nearer term expiration just allows this one to expire worthless, and then maybe we write a new weekly option for the next week that expires worthless, and maybe we repeat that a couple of times, and that overcomes that credit. So let me back up a little bit here. We started with our option right here, and that was originally money in. Maybe when we spend money out right here and just move this into the same strike price, because at this point in time, we may not want to be at a 35 or a 34 strike price. The stock might still get a little bit of a pop and move us in the money too quickly. When we're in a calendar spread, that's not always a good thing. So we look at this and say, I know that this money in right here in this option is not going to be equal to what I spent right here, but maybe a combination of this money in, this one expiring, this one with money in and then expiring, and this one with money in and then expiring. Maybe a combination of these. We're speculating, we're guessing right here. So there is some speculation right here, but we're making an educated guess and saying, you know, the value of these three options and the money in that I should bring in from these could be significantly greater than the money out spent right here, and that could prove to be quite a profitable situation. So again, let me repeat, let me go back to kind of the starting of this thought process. Ideally, when we spend the money to close this option, when there's money out right here, ideally, the first roll of this option into a nearer term expiration date is going to be better off if it's also down to a lower strike price, such that the money in here will simply cancel out or at least be equal to the money out right here. That's ideal. We're not always going to be able to do that. So then we have to look at, could we successfully see 2 or 3 weekly short calls expire worthless, thereby creating the situation that we want. Now, good question came in as I wanted to finish this thought process so I didn't stumble through it. Question came in, would an approaching earnings date adversely affect this? The answer is absolutely yes. I don't know if the question, I need to look at the question again. I don't know if she said adversely affect it, but would an approaching earnings date have an effect on what we do? Yeah, absolutely. We talked about in the class yesterday, we did it live yesterday, but you may have listened to it just moments ago if you're following the recordings. So we talked about when we originally set up this bulk call spread, there may be an earnings date in between the time we enter the trade on those technical crossovers right here and the time when the options expire. It's probable that there will be an earnings date right there. but we want to make sure this earnings date is not going to take place prior to our hopeful target exit. Maybe we were hoping to exit right in here. And so anything we do with those options, when we're rolling this option in, we have to do so with the idea in mind that I've got to try and get out of this trade before I get to the earnings date, if at all possible. And so maybe I need to be a little more aggressive if that earnings date is coming up at the beginning of the next month. Maybe I can be a little more conservative if that earnings date is towards the end of that month, or maybe just barely before the expiration of my options. So the farther away, here's the clearest way I can answer that question. It's a great question. The farther away you are from the earnings date, the more aggressive you can afford to be with the placement of that new short call. When you're rolling the short call and you're closing the old one and opening the new one, you can afford to be a little more aggressive with the placement of that short call. Now, I want to take a moment. I'm going to deviate for just a moment and make kind of a little side note here. One of the most challenging things in producing classes like this and putting classes online like this is kind of this whole which comes first, the chicken or the egg kind of thought process. Do I teach all of the different strategies and none of the adjustments and then go back and then in succession teach all of the adjustments? Or do I teach a strategy and then teach how to adjust that strategy? Now, I'm not going to talk about this in every adjustment class that we do. You're only going to hear this in this adjustment class. I'm talking about adjusting into a calendar spread. And if you're brand new to options and you're brand new to what we're doing, you don't know what a calendar spread is yet. You haven't seen or been taught what a bull call calendar, a regular horizontal call calendar, or a bear call calendar spread is. And here I am talking about the best adjustment to a bull call spread that has moved against you is a calendar spread. Okay, I don't know if there's a right or wrong way to do this. I've tried the other way around for a few years. I taught all of the strategies, and then I taught the adjustments to the strategies. And I found that every once in a while I'll do a survey of some students, and I found that people were jumping back and forth. They would do a strategy, and before they'd learn other strategies, they'd go out, they'd skip ahead and do the adjustment class for that strategy because they wanted to place a trade right away. So then I thought, if I teach the strategy, then I've got to teach the adjustment. Well, now the adjustment takes you into a strategy you haven't learned yet. So this is all I'm going to comment on this. Do what works best for you. I've set up an order for these classes, but if you want to skip around, when you're done with this class, whether you're listening to me live as we're getting a new recording right now, or whether you're listening to the class that was recorded, when you're done with this class, if you want to jump ahead and look at the calendar classes and see what calendar spreads are and how they work, and then look at how we adjust calendar spreads, you can absolutely do that. I don't make anyone finish one class in a certain order before they can jump to another class, because I think you need the freedom and the flexibility to jump around like that. So this is just for the sake of people who may be listening to one of my classes for the first time, or one of the core strategy classes for the first time, and I just wanted to make that little side note. Now, another question came in, and this I'm gonna preemptively tell you, this is one of the hardest questions to answer. And that is, a question came in, how do you define too slowly? Okay, and here's what the person means by that. I'm going to back up a couple screens. We're talking about the adjustment we make if the stock is still trending bullish, but it's trending slower than we need. And how do we know it's trending too slow? Well, the most perfect answer to your question is we don't. We have to make an educated guess. The better answer to your question on how do we make that educated guess, the only thing you can do right here is look at a chart and draw a trajectory line. Right here, our trajectory, if we took this current trajectory that the stock is on as it's moving up like this, and we simply projected it out on our stock chart, then we can go out and look at the date that we're hopeful, that 3 to 4 weeks, maybe 5 or 6 at the very most. Let's say we're looking and saying 6 weeks is the longest I want to be in this trade. So I'm going out here 6 weeks and drawing a line. I'm going to show it to you this way. I'm going to do something a little bit different here. Bear with me a moment. It's a great question. I really want to give you a good answer to this question. So I'm going to jump back a screen. I'm going to clear up all these marks. This is why I personally get some enjoyment out of doing these live, because I think it makes the class better for everyone who listens to it going forward when you guys ask great questions. And both of these questions are great questions. Okay, so your question is, how do we know if it's going too slowly? Let's say this is the date we're getting into the trade. Let's say the crossovers came and the next day we decide we're going to open a bull call spread somewhere right around July 13th, July 14th, 15th maybe. Okay. Right now, we can't see any of this. None of this is visible to us. We don't know this is going to happen. But we're going to count out 1, 2, 3, 4, 5, 6 weeks, and we're going to say, you know what? The Friday expiration of this particular week right here marks 6 weeks in this trade. I want to be out of this trade prior to the end of that 6 weeks. Now, right now today, this is all I can see. That's where the chart ends. I'm going to draw a trajectory line, as even a line as I can draw. Forgive me if it's off a little bit, but I think that's pretty close. I'm going to draw that line, and I'm going to say, if it maintains the trajectory that it's on, and sometimes stocks do a great job of doing that for a good 4, 5, 6 weeks, and other times a 3-week stretch has them moving up, moving down, and moving up again. So we're just making an educated guess here. But I'm looking at this trajectory and I'm saying, okay, this is the path that I'm moving on, and I'm looking at my deltas. I'm getting a 34 strike option, I'm getting a 36 strike option, and I'm looking at the delta, and I'm estimating that somewhere around $35 a share is where I reach my target profit of, say, 20%. And I'm saying, look, on this trajectory, I could hit that in the first 2 weeks that I'm in the trade. I get in right here. I could maybe hit it in a week. Worst case scenario, I hit it somewhere early in the 2nd week of this trade. That would be a fantastic bull call spread. We would love it. But before we get out, clicking the wrong buttons here, bear with me. Before we get out, let's say we didn't get this outright reversal, but let's say we got here to 34.5. We got the one day that closed up higher, wasn't quite enough to get us out. And let's say the next day it opened here, and now we get 3 or 4 trading days in a row that are just flat. Well, now our trajectory changes a little bit. We're going to look at these flat days right here, and this line is not going to be quite as high. It's going to be kind of doing something more like this. And we're going to say, well, look, it looks like I could still get as high as I need, but now I'm looking at getting there a little closer to the 5-week mark or 4-week mark. And so maybe I wait another couple of days. This is the hardest part of any trading we do. This is the most challenging part of what we do, is getting this timing just right. And now let's say I get another couple of days, and what I've got to do now is I've got to take this right here and I've got to put it in context with that level of resistance that it hit and held, and I've got to put it in context with this level of support that it tested right here. And now I've got to say, you know what, the long-term trend, even though for a couple of weeks it looked like it was going to break out, now it's bounced off some resistance and it has not broken out. Hasn't turned bearish on me yet, but I can tell now that this trajectory right here may or may not ever get me to 35 in time to get out of this trade. And when I've made that determination, and I might make it off of this first bounce off of resistance, I might give it one more bounce off of resistance. My preference is a second test of resistance. That's my preference. But I'll tell you an exception to that. I might want it to make a second test of that resistance mark if it was right there at 35. But if I tested resistance and then came down here and hung around the low end of this channel for another 2 or 3 or 4 trading days before I get a test of this resistance, I'm making the adjustment. I'm rolling that option. I may not wait for that. If I get a second test of resistance, it's a no-brainer. If I get a test of resistance and then it just kind of tapers off slowly or sort of hangs towards the bottom side here of this range, then I'm calling it and making the adjustment. Now, one of the things we told you in the bull call class, one of the things we told you is that ideally you want to be in the trade for 2 to 3 weeks, but 6 weeks is kind of a maximum. If I'm not still on the trajectory that will get me to my target profit, if I'm 2 weeks in and I'm not on the trajectory that still looks like I could get there in the 3rd or the 4th week, I'm going to reanalyze that trajectory and probably go to my adjustment. It's the hardest that when you're doing a traditional bull call spread, it's easier to adjust to a bearish trend than to make the determination, am I bullish but just not fast enough bullish? That's the harder adjustment. That's the harder thing to determine. I'm still bullish, nothing has crossed over to the bearish side, but it doesn't look like it's going to be fast enough. That's not an easy determination to make. Relative to, oh, look, everything crossed over to the bearish side. I can say without any hesitation that I'm moving bearish now on this company. And that's an easier determination to make. So let's go to that scenario. That's a good segue into that scenario. So we get into the trade. We've got that 34 strike short call, that 36 strike, or 34 strike long call, 36 strike short call. And suddenly we've reversed. And the trend has just absolutely changed on us. We could roll our short call straight down to a lower strike price and leave it in the same month of expiration and turn this into a bear call spread. Now again, this is a trade you haven't been taught yet. So if you want to, when you're done with this class, jump ahead and look at what the bear call spread is. You could move the short call below the long call and get into a bear call spread. When the stock is moving down, what is happening to both of these options? They're both losing value, right? The long call is losing value, the short call is losing value. If you took in, let's go back to our scenario that we talked about. We had 30 cents a share. When this stock has gone from 34 down to 32.5 in just a couple of days, you know you're going to buy this back for a lot less than 30 cents a share, right? Do I even need to ask? Do I even need to pose that as a question? You know that you can now buy to close that for quite a bit less than 30 cents. And you know that when you're moving down in strike price, whatever you sell to open is going to bring in maybe not more than 30 cents, but you know it's going to bring in a lot more than the money out you spent right here. We might at this time only spend 5 cents money out right here. Don't have room to put a zero in front of that. We might spend 5 cents. Probably we're picking up 20 or 25 cents right here. It's when you're rolling a short call down, it is easy to pick up more credit on the new short call than what you are spending on the old short call to close it. Think back a couple of classes. I told you there was a rule that I would repeat over and over and over again. You're going to hear this until you're either sick of it or until it sticks. And once it sticks, I hope you don't become sick of it. It's vital to adjusting trades. Always try to get more money on the new short option than what you are spending to close the old short option anytime you roll a short option. This does not only apply to short calls. This applies to short puts. This applies to collar trades, spread trades, whatever you're doing. Always try, when you're rolling a short option, always try to get more money in than money out on that roll. That should always be your goal. Now, you could also roll the short call down and into a nearer term expiration day and create a horizontal call calendar, or if that short call was a lower strike price, you would be in a bear call calendar. This depends a little bit on the trend. It depends a little bit on when that earnings date is. That we had a question about the earnings date earlier. You're going to look at this and say, okay, I've got a new trajectory, but it's not. Let me do this again. I want to go back to this other. This is the only stock chart I have in the presentation that's got the whole screen as a stock chart. So now I've got this new trend, but right after breaking a level of support here, this thing is kind of flattening out a little bit. My trend is still bearish, but it's flattening over this past week. So I may not want to roll right straight down to a bear call where the stock could potentially stay at or above the strike price. I might want to come into a nearer term expiration down to a lower strike price, but still give myself some room between where the stock is trading and the strike price of my new short option, because that makes future adjustments easier. Remember one of the things I said in the class, in the introduction to adjusting trades, I told you that whether it's a game you like or not, at least to some degree, you've got to start thinking like a chess player. You've got to start thinking a couple of moves out in advance and thinking a couple of moves ahead. If I adjust to this trade, how easy is it to adjust back to this trade if this thing reverses again and goes the other way? How easy is it to adjust this down into another strike price as it comes close to expiration or as the stock continues to trend down? These are all things that you have to consider. Once you're in this call calendar spread, if you get an option expire worthless, you have a weekly or monthly option that you can short another option. And just like we answered the question before, you can be a little more aggressive when you're still a little bit farther away from that earnings date. You got to be a little more conservative. Meaning, more aggressive means you're going to place this closer to where the stock is trading to get a bigger credit. That's what I mean by more aggressive. Your strike price of your short option is going to get a little closer to the price of the stock when you've got a little more time, therefore a little more flexibility to turn it around. Let's look at some actual numbers. Remember the trade we set up in the previous class? I told you I had some newer option chains in here. We weren't sticking with everything from an older version of the class. Remember the trade we set up in the previous class were between 45 and 90 days out to expiration. We paid $2.78 for our long call. We took in $1.14 for our short call. Our net debit in the trade, $1.64 per share. Max risk, $1.64. Possible return of $3.36. We've got a couple 100% possible return. Great trade. Now, let's say hypothetically, the stock has reversed, and now we've got to do something different. Keep track of the money in, money out. It was $1.64 money out to open this trade. Right now, at this moment in time, we would have to spend, I should have highlighted the $1.19, because we would actually have to spend $1.19 to exit this trade. Okay, that would be money out. And we could get, potentially, by rolling straight down, we're going from 45 strike price. I know it goes the other way on the option chain. We talked about that. By going from the 45 strike down to the 37.50 strike, we're going to get $1. We're going to get $4 a share for the new option. Money in. A lot more money in than money out. Pretend that's a 19 since I circled the wrong one. Okay, 164 plus 119 minus $4 is 127, or excuse me, 117. That's the 5 cents that I missed right here. So we're going from a debit spread to a credit spread. We're going from a debit spread to a credit spread with the roll of that option. This is the one, I'm going in reverse order now. This is the one that I showed you most recently where we roll straight down to a bear call spread. If we were going to roll to a calendar spread, there's the $1.64 to open the trade. We're going to spend, once again, I circled the wrong one. Always assume this is your bid column, this is your ask column. Always assume when there's going to be money out that it's going to be the ask column. Someone's asking you for money, it's going out. They're always asking you for more. Okay? We're moving into a nearer term expiration. We're moving down a strike price from 140 or from 45 down to 42.50. We're going to spend $1.19. We're going to take in $1.31. We're going to turn this into a calendar spread. If this was 119 and 131, we'd have a new debit 5 cents higher than that, so it would be 152 would be our new debit in the trade. So we've gone from a 164 debit to a 152 debit. As long as the money we're bringing in here is equal to or greater than the money we're spending, the money out right here, we're either going to maintain or improve our cost basis. And that's part of the goal of the adjustment. Change your cost basis to your favor and give yourself an opportunity to get back to a break even or profit in the trade. And when you're looking at this 131 right here, and you're looking at August, you're asking yourself a question: is it reasonable that I could get another 131 if and when this option expires? And you're guessing on that. You're saying, okay, in 39 days when this option expires, there will still be close to 30 days left in this one. So isn't it reasonable to assume that if the stock is trading kind of flat and at a similar price, I could maybe get another $1.31? Maybe 30 days from now, this one, instead of being worth $1.80, is worth $1.31. If the stock price stayed about the same, you're making educated guesses here. And maybe you've got a couple of months. Maybe if this had started out in October, we could have August and September monthlies and maybe some weekly options in there. You're playing a little bit of a guessing game. When you look at this credit, you're saying, well, gosh, this is only going to lower my cost basis by 12 cents a share. However, if I can lower it, if this expires worthless and then I can lower it by another $1.31, now I'm getting back towards a break-even trade. These are some of the things you take into consideration. When the stock price in a bull call spread moves too slowly to get the profit we want, we can adjust to a bull call calendar or a call calendar by rolling our short option into a nearer term expiration and possibly down to a lower strike price. When the stock price for a bull call spread moves down, if it's moving down slowly, we would probably go to a call calendar or a bear call calendar. If it's moving down a little bit faster, we could roll straight down into a bear call spread. But before you do that, make sure you've watched the class for the bear call spread along with the adjustment class for the bear call spread. So I'll say one last time, I'll give one last reminder: jump around. You don't have to go in the exact order that the classes are in. If you go in the exact order that the classes are in, or that the way they're arranged on the website, don't do any trading until you've finished everything. I can't advise specific trades anyway, but I would say don't do any trading until you've gone through all of them so you know what you're adjusting to and what your next adjustment might be from that point forward. That wraps up adjusting the bull call spread. Thank you, everybody. Oh, one last question came in. I'm glad I saw this question. I was just about to end the class. Is there a preferred order for the adjustments? Okay. you really let the direction and the trajectory that the stock is now moving on dictate. But I will tell you this, and it's a great question. I would always prefer moving to a calendar spread first versus moving into a bear call spread. Now, if the stock is just going slow, that's probably going to be a bull call calendar. If it's flattening, that might be a horizontal call calendar. If it's going a little bit bearish, but not a strong bearish move, that may be a bear call calendar. Whichever of those three it is really is determined by the trajectory of the stock price, and you've got to give it a few days of trading to really make that determination. But I would always prefer to go into a calendar spread ahead of going into a bear call spread. That would always be my preference on this particular trade. Great question. Great spot to end. Thank you, everybody. For those of you that were able to be on with me live, have a great day. If you're listening to a recording, onward to the bear put spread. Thanks, everyone. Bye-bye.